But we have that sort of larger issue to discuss. Like I said, it's all about IndusInd Bank. The stock, of course, saw some recovery yesterday. There was some buying early in the morning as well. Yeah, it's still up about 1% or so. But questions still remain after what was a massive 27% drop. And I think, a wipeout on that day for almost 20,000 crores in market cap. And all because the bank disclosed discrepancies in its derivative portfolio. Now, the bank's management obviously told us that this is a one-off instance and they're sort of very, very clear on disclosures and corporate governance norms. But we also understand, actually, from our colleagues in Money Control, that perhaps this is something that will get the RBI to open up a much wider review, should I use the term. Yeah, we've got those graphics up. That's what Money Control is reporting, that the RBI is now opening up a wider review of all other banks, private as well as PSU. To look at how banks are, looking at their derivative accounting, their trading books, and if there are any other discrepancies anywhere else. Let's talk about this. Karan Gupta, Director and Head of Financial Institutions at India Ratings, is joining in. And we also have Abhizir Devanji, founder at Neostrat Advisors, both experts in the financial arena. Thank you very much, gentlemen. So I'll come to what our sister concern Money Control is reporting in just a bit about a wider review and how you account for derivatives. But first, on IndusInd, Abhizir, massive, hit to sentiment, to confidence, really. And I think the market's entire issue was that if you knew this way back in October and you decided that there are some discrepancies and you need an external review, why didn't you disclose? Why didn't you tell the market? What are your thoughts on the way the whole saga played out and the CEO's explanation, which I'm sure you would have heard?
Yeah, so Surabhi, very frankly, why did it not come out earlier? I guess it's the bank would have best known why they did not do it. But very clearly, what would be also the case is that before you actually come to the markets, they would actually want to make sure that they know exactly, they've sized up the problem well and they've understood it well. That could have been a very big concern. And derivatives, frankly, as a accounting class or even as understanding what derivatives are about, actually is a very complex arena. So in my view, maybe the delay is because they were trying to size up what the issue was and whether it was prevalent, whether it was only a one-off incident, whatever. And as and when the bank would have got some level of comfort, they would have actually, come back to the investors. By the way, RBI would have obviously been informed much earlier. So it's not that the issue was completely hidden and within wraps within the bank. I'm sure consultations with the SSM would have been live as the issue would have been discovered.
But I guess delaying that disclosure to 5-6 months later, saying we'll tell the market when we have better clarity, that doesn't really help, right? It anyway damaged sentiment. It damaged, obviously, your market valuation as well, investor wealth as well. But, the bigger issue is understanding what is this accounting discrepancy. Let me bring in Karan as well. Abhizir, I'll come back to you, because what Mr. Katpalia told us was that there is apparently this internal desk and there's an external desk, and one desk did not account for the loss and the other didn't account for the gain, or something of that sort. Like you're saying, it's very complex. Karan, can you tell us a little more about the accounting methodology right now and what you understood out of this discrepancy that perhaps IndusInd, in this specific case, is speaking about?
So, what they've highlighted is that the internal desk or some part of their foreign currency borrowings, as well as deposits that they had, and they held hedges against that, which were not disclosed earlier and have now been disclosed to the market. So that's where it stands at the moment. We are also having discussions with them where we will get to know about things in greater detail, but that's where it is at the moment.
Abhizir, come in on this internal desk, external desk, one not counting for the loss. I mean, it's, at the end of the day, it's 2,000 crores. It's not like, 1-2 crores here and there. It's 2,000 crores we're talking about. How does this happen?
So let me explain what happens generic. Obviously, IndusInd, I am not part of the investigating agency, so I don't know. Yeah. But actually, I can tell you what happens normally in banks. So banks normally follow some kind of a siloed approach in everything. So they kind of distribute risk differently. So what they do is, there is an external deposit sourcing mechanism, which will source a deposit. Then they would designate it internally as a hedge. So they would say, okay, this is a hedge transaction. I'm going to hedge it. So internally, they would transfer it to the treasury desk internally by assigning certain, so they would do a swap. So
And this is a
for
foreign,
example,
Abhizir, just to understand, and what we're talking about, this is an external deposit. It's a foreign currency deposit that a bank
yes,
gets.
it's a foreign currency
Okay.
external deposit. That's the external
Okay.
leg from
Yeah.
the deposit sourcing side. Then internally they do a synthetic hedge
Okay.
to say that I will
This is
offer
a hedge
this to
against the
my
deposit,
treasury
yeah.
at this particular rate. And
Right.
when they do the synthetic hedge, they record that hedge as a accrual accounting. So what it really does, it says, okay, the whole transaction is hedged. I am not exposed to any risk, either currency or interest rate risk. Correct?
it.
So,
Got
so
it.
the,
Got
the
it.
deposit taking department is not exposed to the hedge. And what they then do is that they size up what is the loss, because clearly there is a loss. If you're sourcing a yen deposit which is cheaper, there'll be obviously a cost of acquiring that deposit. So
Yeah.
that is accrual accounted over the period of the hedge. So it just says, okay, if my loss is 100 and the period is 10 years, I'll divide by 10 and I'll record 10, amortize 10 over 10 years.
So in
Then
this case,
this
the
exposure-
synthetic.
This
Sorry,
is
please
synthetic,
continue.
internal,
Yeah, yeah, please
internal
continue.
in the bank, internal
Yeah.
in the bank.
Yeah.
Then what happens is that the treasury desk takes that exposure on its books and tries to hedge it in the market.
Okay.
So they actually get hedges in the market. Now what happens is the internal is based on certain benchmarks that they have devised, the bank has devised themselves. The external reality may be a little different. So actually there is no perfect hedge between what has been externally sourced and what is externally hedged.
Okay.
Now, because accrual accounting happens in the internal book and the mark to market happens in the external book,
Okay.
there is clearly a gap
Okay.
where as long as you're making money, there is no problem. But when you unwind that transaction, when a deposit gets prematurely withdrawn, for example, that is when the loss is highlighted, because the accrual accounting that is done internally doesn't match with the mark to market, which is done
Mark to
externally.
market. Got it. Got
Correct.
it. And that's where the
results in
gap
the
shows
larger
up.
loss. That
Got it,
results
got
in
it,
the larger.
got it. Now we've understood, what the issue was. The question is whether this is just a, one-off, freak miss, or whether perhaps other banks are also missing these gaps, especially in times of high currency volatility. Karan, what's your sense on this? Because this seems to be a wider review that the RBI has now launched.
So, when incidents like this come to the fore, what RBI would do is it would initiate a kind of a thematic audit, whereby, they will go ahead and ask all banks to provide data to give them comfort that nothing of this, similar has been left out in terms of disclosures to the market. I think that's the way this is progressing at the moment. And RBI is likely to reach out to other banks as well and get those get that data in place.
Abhizir, what's your sense? I mean, you've seen the sector for decades. Could there be risks of other such gaps or forgotten loss declarations showing up in other banks as well? Or could this be just a one institution specific incident?
So from an accounting and reporting perspective, I can tell you derivatives is the least understood. By the regulator as well as the market, very frankly. So in my view, could there be other issues that may come up in other banks as well as this bank? It's quite possible. Because the RBI came out in the 2024 circular precisely because of the gap that they identified. And they said that, listen, this is not working because the internal transfer pricing is not matching with the external hedge. And hence they said that you cannot have any open positions at all and you need to hedge everything in the market. When the circular came out, even IndusInd started investigating their books. So ideally, when every bank will start investigating their books, they may find these gaps. How large those gaps are will clearly depend on positions taken by the respective banks. But I think now there is going to be a lot more awareness of how treasuries function. So I worked in a treasury before, and really what the rule, especially in foreign banks, is in their international operations, is that you simply go and hedge everything back to back. That's it. Don't worry about an internal book or an external book. You simply go and hedge every exposure the bank is taking.
And wherever there's a loss, let it clearly show up and communicate. Yeah, communicate it to the, to the
If it's an equal and opposite between the internal and external book, the loss will get recognized and the gain will get recognized.
Okay.
I think that is how. So RBI will clearly want this to be investigated. I don't know whether RBI will have the skill sets to do it, but very clearly there is a skill set gap in the market itself to assess how this is to be done.
Oh, okay. Karan, now in light of these fresh developments and what both you gentlemen are saying that this could be evident maybe in other banks as well, because now the review is on. So now we'll figure out, where the gaps are and what's going on. Does this open up a brand new regulatory risk? The market thought it's all fine. I mean, we were completely okay from a liquidity standpoint, from a rate standpoint, rate cuts happening, asset quality was fine. There was nothing else in terms of a fresh risk. Is this one now for the financial sector?
So see, when we are talking about banks, right, the narrative around the sector has completely changed over the last few years. We are no longer in a position where we are complaining about, the sector being in need of capital or the asset quality being under pressure, or even the profitability, not being up to the mark. So this, at the moment, has to be taken as a one-off. We'll have to wait to see what the review brings out in terms of if other banks are also going to be impacted by this. But at the moment, I don't think one needs to paint the whole sector with the same brush. That's where I would leave it.
Abhizir, your thoughts? Investors these days in a falling market, everybody will come and tell you, go buy banks. Everything's fine there. But now, what about this? What would your advice be?
I don't think the banking sector is at risk, nor are banks at risk, including the one.
No, not at risk. I didn't mean at risk. I'm just saying a new unknown, and the market always dislikes new unknowns, unpredicted.
So really what's happened is, and I think I agree with Karan, that this risk is something that will have to be measured, and I don't think it may be all pervasive in banks. But what is happening is the external environment is changing aggressively. As countries turn protectionist and as tariffs happen and those kind of things are happening, you will find exchange rate volatility to be there, interest rate volatility to be there. And the banks will have to learn to manage them more dynamically than they would otherwise be doing. So clearly that will result in a new risk in terms of the banking sector, because until now exchange rates have been moving north, may not necessarily happen going forward.
No, got it. So this is...
It has to be controlled.
Absolutely. And this is a new X factor, so to speak, that's kind of crept up. Just a final word, with Vishal as well. With Karan as well. Karan, X of this issue, which is a completely new one, just leave us with your broad forecast in terms of credit uptake, in terms of, the peak of the asset quality stress, credit costs as we are entering FY26. Just remind us of your overall projections.
So in terms of the overall projections for the banking system, we are forecasting about 13.5% year-over-year loan growth for FY26, and deposit growth also should be in the region of about 12.5, which means that the gap that one was seeing over the last few years between credit and deposit growth, which led to the LDRs increasing, that is going to get minimized over the near future. However, the picture for NBFCs is slightly different. Therein, we are more mindful about the credit costs increasing because of certain asset quality pressures that we've been seeing in asset classes like unsecured business loans, MFIs, and to some extent, even personal loans as well.
Okay. All right, Karan and Abhizir, thank you very much. Very helpful perspective. And I think at the end of this conversation, what we do know is that investors need to strap up for maybe some more uncertainty on this whole derivative issue. It might not be restricted to just IndusInd Bank alone. Let's see what the next couple of weeks and months bring.